Wall Street just saw a notable shift in sentiment, driven by data points the retail market often oversimplifies. Today's softer producer inflation numbers didn't just ease interest rate concerns, they fundamentally altered the near-term risk perception for institutional capital. This isn't just about a single data print, it signals a potential pivot in the Federal Reserve's restrictive stance, impacting asset allocation across the board. The immediate reaction saw major indexes like the S&P 500 and Nasdaq climb. But this isn't merely speculative buying. It reflects a re-evaluation of the equity risk premium in a potentially less hawkish rate environment. The market's core business, the discounting of future earnings, suddenly looks more attractive. The moat here is the agility of capital to reprice risk assets quickly. Consider this dynamic. A slowing pace of producer price increases directly translates to potential margin relief for corporate America down the line. That's a structural advantage, not a fleeting trend. This shift reinforces the value proposition of quality earnings in sectors with robust pricing power, even as input costs remain elevated in some areas. Now, let's look at the broader earnings landscape. While specific company numbers are still rolling in, the market is digesting a mixed but generally resilient picture. Analyst consensus for aggregate S&P 500 earnings has been revised higher, reflecting a surprising degree of corporate adaptability. That's not a small detail, it's a testament to underlying economic strength. Here's where the margin metrics become interesting. Despite persistent labor and material costs, many corporations have successfully navigated these pressures through efficiency gains and strategic pricing. We're seeing pockets of margin expansion in some sectors, contrasting with contraction in others. This divergence highlights the importance of granular, bottom-up analysis for portfolio managers, rather than broad-brush assumptions. The next signal comes from management's capital allocation and, more broadly, central bank policy. The softer inflation data empowers the Federal Reserve with greater optionality. Their commentary suggests a cautious but data-dependent approach. This implies less aggressive rate hikes and potentially a sooner pause, a critical input for corporate planning and investment decisions. That leads us to the corporate M&A landscape. News of a reported $53 billion takeover bid for PayPal, for instance, isn't just about one company, it's a potent signal. This kind of M&A activity reflects renewed corporate confidence in future growth and a willingness to deploy capital for strategic expansion. It's a key indicator of where smart money sees value and structural opportunity. Now look at how the broader sector is reacting. The global macro environment still presents headwinds, with geopolitical tensions and uneven growth rates across economies. However, the domestic picture, particularly with easing inflation, offers a relative insulation. This is driving a nuanced capital rotation, favoring sectors with strong domestic demand and less exposure to global supply chain volatility. Competitive landscapes are also evolving. Companies that demonstrated pricing power and operational efficiency during the inflationary peak are now better positioned. This reinforces structural advantages for market leaders. Investors are scrutinizing balance sheets and free cash flow generation for indicators of true relative strength in a challenging, yet improving, macro backdrop. But let's not get ahead of ourselves. Significant risks remain. The battle against inflation is far from over, and any reacceleration could quickly shift central bank policy back to a hawkish stance. Yield pressure on longer-dated bonds, for instance, could tighten financial conditions unexpectedly. That's a systemic headwind that institutional investors are constantly monitoring. Another vulnerability stems from potential regulatory pressure, especially in high-growth tech sectors, or unforeseen liquidity shifts in credit markets. While the banking system appears robust now, any sign of stress could cascade. Systemic headwinds require constant vigilance. We're talking about tail risks that can't be ignored in any balanced portfolio strategy. Looking forward, the market appears to be pricing in a soft landing scenario, especially with the latest PPI data. This implies a more constructive outlook for forward earnings visibility. Valuation reassessment will favor companies demonstrating consistent free cash flow and a clear path to sustainable growth, even if overall economic growth remains subdued. The multiple expansion could still have room. Upcoming catalysts include the next CPI report, further Fed commentary, and the ongoing corporate earnings season. These events will either confirm or challenge the current narrative of easing inflationary pressures and a more accommodative monetary path. The multi-year thesis now leans towards strategic capital deployment in resilient sectors, focusing on companies with demonstrated pricing power and operational leverage. So, what's the tactical review? Certain cyclical sectors and quality growth stocks, particularly those that have shown relative strength through this cycle, warrant a breakout watch as liquidity shifts. Conversely, highly levered companies in sectors still battling margin compression might be trim consideration candidates as rates stay higher for longer, even if the pace of hikes slows. The strategic closing perspective is clear. Institutional capital is navigating a nuanced environment where macro signals are increasingly dictating micro opportunities. Don't be swayed by fleeting headlines. Understand the structural shifts. For deep dives into market intelligence and equity research, make sure you're subscribed to SRMoneyNews. Hit that subscribe button and turn on notifications so you never miss our institutional grade analysis. Stay informed, stay ahead.